on project investment evaluation techniques. My name is Monica Rossolini and I am Assistant Professor in Banking and Finance at the University of Milan Bicocca, Department of Business and Law. In this lecture, we analyze different topics. Firstly, we discuss about the importance of project evaluation and the so-called capital budgeting. Then, we analyze in detail two main groups of project evaluation techniques. The first group is represented by techniques that don't consider the time value of money, in particular return on investment and payback period. In the second group, we analyze techniques that consider the time value of money, net present value, and internal rate of return. Let me start focusing on the importance of project evaluation. Capital budgeting is the process of analyzing and ranking proposed projects to determine which ones are deserving of an investment. The result is intended to be a high return on investment funds. Capital budgeting is a step-by-step process that businesses use to determine the merits of an investment project. The decision of whether to accept or deny an investment project as a part of a company growth initiatives involves determining the investment rate of return that such a project will generate. However, what rate of return is deemed acceptable or unacceptable is influenced by other factors that are specific to the companies, to the sector, as well as the project. Unlike other business decisions that involve a singular aspect of a business, a capital budgeting decision involves two important decisions at once: a financial decision and an investment decision. By taking on a project, the business has agreed to make a financial commitment to a project, and that involves in its own set of risks. Projects can run into delays, cost overruns, and regulatory restrictions that can all delay or increase the projected cost of the project. In addition to a financial decision, a company is also making an investment in its future direction and growth that will likely have an influence on future projects that the company considers and evaluates. So, to make a capital investment decision only from the perspective of either a financial or investment decision can pose serious limitation on the success of the project. Capital budgeting, as a part of budgeting, more specifically focuses on long-term investment, measure capital and capital expenditures. The main goals of capital budgeting involve ranking projects and raising funds. Actually, the real value of capital budgeting is to rank projects. Most organizations have many projects that could potentially be financially rewarding. Once it has been determined that a particular project has exceeded its hurdle, then it should be ranked against peer projects. The highest ranking projects should be implemented until the budgeted capital has been expended. Another important goal for capital budget is raising funds. When a corporation determines its capital budget, it must acquire funds, and it needs to determine which are the best sources of finance for that project. Capital budgeting and project evaluation techniques are very important because they mostly rely on long-term investment. The implications of long-term investment decisions are more extensive than those of short-run decisions because of the time factor involved. Capital budgeting decisions are subject to a higher degree of risk and uncertainty than are short-run decisions. In this slide, a list of the main investment evaluation techniques is presented. You can observe that they are grouped on the basis of the fact that they take or don't take into consideration the time value of money. Evaluation techniques that don't take into consideration the time value of money are return on investment and payback period. The evaluation techniques that take into consideration the time value of money are net present value and internal rate of return. What is the meaning of time value of money? It is strictly connected with the concept of present value. The concept of present value or present discounted value is based on the common sense notion that $1 of cash flow paid to you 1 year from now is less valuable to you than $1 paid to you today. The term present value can be extended to mean the present value of a single cash flow or the sum of a sequence or group of cash flows. Let me start with the presentation of project investment evaluation techniques that don't take into consideration the time value of money. We analyze return on investment, ROI, and payback. Let me start with the return on investment. Return on investment is a performance measure used to evaluate the efficiency of an investment or compare the efficiency of a number of different investments. ROI measures the amount of return on an investment relative to the investment cost. To calculate ROI, the benefit or return of an investment is divided by the cost of the investment. The result is expressed as a percentage or a ratio. The return on investment formula is the following: ROI equal to the gain from investment minus the cost of investment divided by the cost of investment. Because ROI is measured as a percentage, it can be easily compared with returns from other investments, allowing one to measure a variety of types of investments against one another. Let me give you an example. Consider the Alpha project, which requires an investment of $1 billion initially, with subsequent cash flows of $100 million at time 1, $200 million at time 2, $400 million at time 3, and $500 million at time 4. We can characterize the project with the following end-of-year cash flows, as you can observe by this table. The question is, what is the ROI of Alpha project? ROI is calculated as the sum of the inflows minus the investment cost, and we obtain a value of $200 million divided for the investment cost. That was $1,000 million. ROI is equal to 0.20 or 20%. ROI is a popular metric because of its versatility and simplicity. Essentially, ROI can be used as a rudimentary gauge of an investment's profitability. The calculation is not complicated, relatively easy to interpret, and has a range of applications. If an investment's ROI is not positive, or if other opportunities with higher ROIs are available, these signals can help investors eliminate or select the best options. The main disadvantage of the ROI is that it doesn't consider the project's time frame. Let me give you an example. Consider Beta project that has an investment cost of $1 billion and an inflow cash flow at time 1 equal to $1,200 million. The ROI, also in that case, is equal to 20%. But do you think that we can consider Alpha and Beta project equal, even if they have the same ROI? The answer is certainly no, because in the case of Beta project, the inflows of $200 million is obtained in 1 year from the starting of this project. The second evaluation technique that we analyze is the payback period. The payback period is the most basic and simple decision tool. The payback period is how long it takes to get the original investment back in terms of undiscounted cash flows. With this method, you are basically determining how long it will take to pay back the initial investment that is required to undergo a project. This table shows the cash flow of the Alpha project. Considering the accumulated cash flows, you can observe that the payback occurs in the last year, the year number 4. One of the main problems of the payback period is that it ignores the cash flows beyond the payback period, so it is not an efficient technique to compare investments. For example, the payback period for both Project Beta and Project Gamma is 3 years, even though Project Gamma provides more value through its year 4 cash flow, as you can observe from the table. The main advantage of the payback periods are the following. It is very easy to calculate and to understand. But it has also some disadvantage. At first, it ignores the time value of money, and second, it ignores the cash flow beyond the payback period. The second group of project investment evaluation techniques takes in consideration the time value of money. Please remember that time value of money is based on the common sense notion that a dollar of cash flow paid to you 1 year from now is less valuable to you than a dollar paid to you today. The two techniques that we analyze are net present value and internal rate of return. The net present value decision tool is a more common and more effective process of evaluating a project. Perform a net present value calculation essentially requires calculating the difference between the project cost, the cash outflows, and cash flows generated by that project, the cash inflows. The net present value tool is effective because it uses discounted cash flow analysis, where future cash flows are discounted at a discount rate to compensate for the uncertainty of those future cash flows. The term present value in net present value refers to the fact that cash flows earned in the future are not worth as much as cash flows today. Discounted those future cash flows back to the present creates an apples-to-apples comparison between the cash flows. The difference provides you with the net present value. The general rule of the net present value method is that independent projects are accepted when net present value is positive and rejected when net present value is negative. The net present value is the estimate of how much the value of the firm changes with the adoption of the project. Net present value is the estimate of the value added or destroyed if negative. Note that when net present value is equal to 0, we are indifferent between accepting and rejecting the project. Let me give you an example. Consider the Alpha project, which, remember, requires an investment of $1 billion initially with subsequent cash flow of $100 million at time 1, $200 million at time 2, $400 million at time 3, and $500 million at time 4. So we can characterize the project with the following end-of-year cash flows presented by the table. The question is, what is the net present value of the Alpha project if the required rate of return of this project is 4%? In the timeline, we can represent the outflow at time 0 and all the inflows at time 1, 2, 3, and 4, respectively. To compute the net present value, we discount all future payments back to the present. Take a look to the formula. Net present value is equal to the initial outflow minus $1,000 plus the present value of future inflows. For time t plus 1, we have an inflows of 100 and the present value is calculated as 100 over 1 plus our discount rate, 0.044, raised to the time, that in this case is equal to 1. Plus the second cash payment is equal to 200 and the present value of these cash payments is given by 200 over 1 plus the discount rate raised to time, that in this case is equal to 2. And so on for the other cash payments. The net present value is equal to $64.06 million. So this means that this project creates value. The net present value has a lot of advantages. At first, it is easy to understand. Second, it considers the time value of money. And third, it considers all project cash flows. But it has also a disadvantage. Result is a monetary amount and it is not expressed as a return. The last evaluation technique that we analyze is the internal rate of return. The internal rate of return is a discount rate that is commonly used to determine how much of a return an investor can expect to realize from a particular project. Strictly defined, the internal rate of return is the discount rate that occurs when a project is break-even or when the net present value is equal to 0. Here, the decision rule is simple. Choose the project where the IRR is higher than the cost of financing. In other words, if your cost of capital is 5%, you don't accept project unless the internal rate of return is greater than 5%. The greater the difference between the financing cost and internal rate of return, the more attractive the project becomes. If the internal rate of return is greater than the required rate of returns, the capital project adds value, and so you can invest. If the internal rate of return is lower than the required rate of return, you don't invest because the capital project destroys value. Consider the alpha project that we use to demonstrate the net present value calculation. Data are presented in the table. The interest rate of return is the rate that solves the following equation. The interest rate of return is the discount rate that gives you a net present value equals 0. The problem in the internal rate of return calculation is that we cannot solve directly for internal rate of return, but rather must either iterate, trying different values of internal rate of return until the net present value is 0, or use a financial calculator or spreadsheet program to solve for internal rate of return. In our example, the internal rate of return is 6.15%. You can calculate the internal rate of return using iteration or Excel. If you use iteration, you try with a value of internal rate of return equals to 7%, and you obtain a net present value equals to minus $23.88. So you try with a value of internal rate of return equals to 6%, and you obtain a value of net present value equals to $4.23. Therefore, you know that the internal rate of return is between 7% and 6% and likely closest to the 6%. If you decide to use Excel, you can use Excel formula IRR. In that case, you create a column from B3 to B7, for example, with all the cash flows in time order. So minus 1,000 in cell B3, plus 100 in cell B4, plus 200 in cell B5, plus 400 in cell B6, and plus 500 in cell B7. And so you applied the IRR formula to the sample from B3 to B7. And you obtain an IRR equal to 6.15%. The internal rate of return presents a lot of advantages and some disadvantages. At first, it is easy to understand. It considers the time value of money and it considers all project cash flows. But it has also a disadvantage. It must be solved iteratively. At the end of this lecture, we summarize pros and cons of the different techniques analyzed. ROI and payback period not consider time value of money, but they are very easy to calculate and very simple to understand. Net present value and internal rate of return consider the time value of money, they consider all project cash flows, and they are easy to understand. But they have also some disadvantages. Net present value result is a monetary amount and not a return. And the internal rate of return must be solved iteratively, and so it is a little bit more complicated to calculate. If you have any questions or you need more information, please feel free to contact me to my email address.